I want to start with something that most of the financial channels will never say out loud, because it does not sell you the thing they are paid to sell. Silver just did something that feels uncomfortable. Not a crash, not a moonshot, something stranger than both. A kind of restless, grinding acceleration that does not match the calm story the big banks keep telling you. And if you own silver right now, or if you have been thinking about it, that discomfort you are feeling is not a reason to look away. It might be the most important thing you notice all year. Because here is what I have learned in a long career watching this metal. The move that changes everything almost never announces itself. It does not ring a bell. It shows up first as a feeling, a strange, unfamiliar tension. The sense that the ground under the price has shifted, even though the headlines say nothing has. That is what silver is doing now. And I want to walk you through why it rhymes so closely with one specific moment in history, the year right before the single biggest move this metal ever made. By the end of this, you will understand the pattern, honestly, with the real limits of it, and you will see why the people who profit from your confusion are working so hard to keep you calm. The title you clicked names a year, and I want to earn that comparison rather than just throw it at you. So let me give you one durable fact to hold on to before we go anywhere near a price. Silver has now run a structural supply deficit for several years in a row. Year after year, the world has pulled more silver out of the ground and out of storage than it has put back. That is not a headline that flashes and fades. It is a slow, quiet drawdown of the metal that actually exists, and it has been happening the entire time the financial media has been telling you silver is boring. Hold that thought, because it is the floor under everything else I am about to show you. Now go back with me to the end of that decade so many of you lived through. Not to the peak, to the year before the peak. Silver had already been climbing for years, part of a long run that started when the dollar was cut loose from gold at the beginning of that decade. But in that second to last year, something in the character of the move changed. The climb stopped being orderly, it got faster and steeper, and it started to feel unfamiliar, even to the people who had been holding the metal the whole way up. It was the kind of move that made seasoned holders nervous, not because it was falling, but because it was rising in a way they had never seen. And here is the part one I want you to really sit with. That uncomfortable, accelerating year was not the top. It was the on-ramp. What followed was a blow-off so violent that silver ran toward the $50 ceiling and briefly touched a level that, adjusted for the erosion of the dollar since then, it has never truly reclaimed in real terms to this day. People who felt that strange acceleration and trusted it were positioned for one of the great moves in the history of hard money. People who felt it and were talked out of it, told it was overheated, told to be sensible and wait for calm, watched the calm never come. The move went vertical without them. I am not telling you silver is about to repeat that exact number. I want to be very clear and very honest with you, because the people who throw around promised prices are usually the ones about to sell you something. What I am telling you is that the shape of the current moment, the emotional texture of it, that grinding acceleration that does not fit the calm narrative, is the same shape that showed up right before the biggest move this metal ever made. History does not repeat on a schedule, but it rhymes, and this rhyme is loud. So let me show you what is actually happening underneath, the mechanics the trading desks would rather you not think about. In this recent stretch, silver has been lagging its older brother. Gold has been powering to record after record, sitting up near levels that would have sounded absurd a few years ago. Silver has been dragging its feet behind it. And when silver lags gold like this, the ratio between them, the number of ounces of silver it takes to buy a single ounce of gold, stretches out toward the wide end of its long historical range. To the crowd, that looks like silver is weak. To anyone who understands this metal, it looks like silver just went on sale relative to gold. The discount got deeper. That is the tell most people miss, and the financial media will never frame it that way for you. Now let me tell you who benefits from you seeing weakness where there is actually a discount. The big banks, the trading desks, the paper machinery that sits on top of this market. They make their money on your churn, on your fear, on you selling into a shakeout because it felt uncomfortable. A frightened retiree dumping metal into a dip is their favorite customer. And the silence about what is really happening underneath, the deficit, the discount, the accumulation by the biggest buyers on earth, that silence is not an accident. It is the business model. They do not want you to understand this, because your confusion is their edge. And that brings me to something I need to share with you, because it is exactly the kind of thing they do not advertise. While ordinary savers are being told to stay calm and stay in paper, the central banks of the world, the most powerful financial institutions on the planet, have been buying gold at a record pace, hand over fist, for years running. They are quietly moving hard metal into their own vaults. And here is what almost nobody tells you. There is a perfectly legal, completely above-board way for an ordinary American retiree to do the very same thing inside the retirement account you already have. You can move a portion of your savings into physical gold and silver through what is called a self-directed precious metals IRA, without triggering taxes and without triggering penalties, because it is a transfer, not a withdrawal. This is not some exotic loophole for insiders. If you have $100,000 or more in a 401k or an IRA, this is available to you, the same protection the central banks are using. If you want to understand how it works, I have put together a free guide that lays it out in plain English. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. No pressure, no obligation. Just the information they would rather you never go looking for. Now let me get back to the case, because it gets stronger. Let me stack the reasons this is not just a chart pattern, but a structural shift. Start with that deficit again and go one level deeper. Silver is not only money. It is one of the most useful industrial metals on Earth. It is in the solar panels going up on rooftops and in fields across the country. It is in the electronics, the medical devices, the electrical contacts, and nearly everything with a circuit. And here is the cruel little detail that makes silver different from gold. Gold is hoarded. Almost every ounce ever mined still exists, sitting in a vault or around someone's neck. Silver is burned. It gets used in tiny amounts, dispersed into a solar panel here and a device there, in quantities too small and too scattered to be worth recovering. So the industrial world is quietly consuming the same metal that investors want to hold, and it is not coming back. That is a supply story with teeth. Now layer on what the central banks are doing, because it tells you where the smart money's head is at. For 3 years running, they have bought more than 1,000 tons of gold a year, roughly double the pace of the decade before. Gold recently passed a milestone that should have been front-page news everywhere and was barely mentioned. It overtook a major world currency to become the second largest reserve asset held by central banks, behind only the US dollar itself. Think about what that means. The institutions that manage entire nations are voting with their reserves, and they are voting for hard metal. They are not doing that because they think the financial system is healthy. They are doing it because they have watched what can happen. When one major power had its foreign reserves frozen a few years back, every central bank on Earth learned the same lesson overnight. Money that lives in someone else's system can be switched off. Gold in your own vault cannot be frozen by another country. And when the giants start protecting themselves like that, an ordinary saver should at least ask why. Here is the part that actually changes the picture, and almost nobody walks you all the way to it. For decades, there was an iron rule in this market. When real interest rates went up, when bonds started paying a real return above inflation, gold and silver were supposed to fall. A bond that pays you to wait is the metal's only true enemy, because metal pays no interest. That rule held for a generation, and recently, it broke. Metal has climbed even while real yields stayed stubbornly high. The old inverse relationship, the one every desk on Wall Street built its models around, stopped working. When a rule that reliable quietly breaks, it is telling you something underneath has changed, that there is a buyer in the market who does not care about the interest calculation, who is buying for a reason older and deeper than yield. That buyer is the central banks, and they are early. Now, I promised you honesty, so let me give you the other side of the ledger, because a case is only worth anything if it survives the counterargument. Right now, the near-term wind is in silver's face, not at its back. The Fed's latest decision left policy tight, and it was a genuinely divided room. Policymakers split, with more than one voice pushing to be even tighter, not looser. The current chair, Kevin Warsh, has made it plain he will not hesitate on inflation, and that he intends to give the markets less hand-holding, less comfort, less forward guidance than they are used to. And a tight Fed, higher real rates for longer, is exactly the kind of headwind that can keep a lid on metal in the short run and stretch out a correction. I am not going to hide that from you. The near-term trend has been down. The moving averages are pointed the wrong way, and silver has been grinding sideways and lower, testing the patience of everyone who holds it. But here is where I want you to shift how you are listening, because this is the hinge of the whole video. Every single one of those short-term negatives is the setup, not the ending. Go back to that year before the blow-off. The climb into it was not smooth either. There were sharp pullbacks that shook people out. There were stretches where the metal did nothing, and the smart, sensible, respectable advice was to give up on it. The acceleration that made the great move possible felt uncomfortable, precisely because it did not come with permission. Nobody sent a memo. The base was built in exactly this kind of grinding, frustrating, sideways to lower action that makes weak hands let go. A long base, tested again and again, is not a sign of failure. It is the coil. And let me show you how thin the paper really is, because this is where the trading desks are most exposed. The price you see quoted all day is not really the price of metal. It is the price of paper claims on metal, contracts traded on the exchanges. And there are far more paper claims floating around than there are actual ounces sitting in the vaults to back them. That is the dirty secret of this market. It works fine as long as almost nobody asks for delivery, and the exchanges have a tool to keep it working. When metal starts moving too fast in a direction they do not like, they can raise the margin, the cost of holding a position, and force leveraged players to sell, all without a single ounce of real supply changing hands. We watched it happen the last time silver approached that $50 ceiling, more than a decade ago. The exchange moved the cost of holding, and silver fell hard in a matter of days, even though nothing fundamental had changed. They can move the cost of holding the metal. They cannot conjure the metal itself. And in a world with a multi-year deficit, that difference is everything. So what do you actually do with all this as a retiree, as someone who cannot afford to be reckless with what you spent a lifetime building? Let me give you principles, not a prescription, because I do not know your situation, and this is not personal financial advice. First, if you are going to own this metal, own the metal. Not a paper promise, not a certificate, not a claim that depends on someone else's solvency. Physical, in your name. Second, size it so that a shakeout can never force your hand. The people who get destroyed in this market are not the ones who are wrong about the direction. They are the ones who used borrowed money or bet more than they could stand, so that a violent dip forced them to sell at the worst possible moment. Size it so you can sit through the storm. And third, do not sell into the shakeout. The whole machinery I just described is built to scare the metal out of your hands at the bottom. Recognize the game and refuse to play your assigned part in it. Now, here is the honest caution, and I want to say it plainly because you deserve it. I cannot promise you a price. I cannot promise you a date. Anyone who does is lying to you or selling to you, and often both. Silver is volatile, genuinely volatile, more so than gold, and it can fall further and stay frustrating longer than feels reasonable. This is a case built on structure and history and the behavior of the smartest institutions in the world. It is a case, not a guarantee. The rhyme with that year before the blow-off is real, but a rhyme is not a promise. What I can tell you is that the setup, the deficit, the discount, the broken rule, the accumulation, the uncomfortable acceleration all point the same direction. And that direction is worth understanding before the crowd figures it out. Because that is really what this comes down to, and it is the piece nobody wants to say to you directly. Right now, you are early. The smart money already sees it. The central banks are already positioned, already buying, already moving metal into their vaults. But the mainstream has not caught on. The pension funds are not there yet. The financial media is still calling silver a laggard, still framing the discount as weakness, still telling you to stay calm and stay in paper. And by the time it becomes obvious, by the time silver leads every news segment and every advisor at every bank is suddenly recommending it, the easy part will already be behind us. The great moves do not wait for permission, and they do not send an invitation. Nobody is going to call you and tell you the moment has arrived. The whole point of understanding the pattern now, in the uncomfortable, unglamorous, sideways part, is that this is the only time being early is still possible. We are not in the obvious moment yet, and that is precisely why this matters now. So if you have watched this far, you are exactly the person I made this for, and I want to give you something more than a video. For those of you who are serious, who have $100,000 or more in a retirement account, and want to understand how this actually applies to your own situation, I am offering a free one-on-one educational web conference. No cost, no obligation, no pressure. It is a real conversation about how to protect and position what you have built and how the physical metals IRA fits into a retirement plan. This is not a sales pitch dressed up as advice. It is the kind of calm, unhurried conversation you can only really have while nothing feels urgent, while the decision is still cheap and reversible, which is exactly right now, before the crowd arrives and the calm is gone. If you are watching this on your TV, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Mention that you watched this all the way to the end and that you have 100,000 or more, and my team will set it up. Let me leave you where we started. Silver just did something uncomfortable, a strange, restless, unfamiliar acceleration that does not fit the calm story you are being sold. The last time this metal moved with that exact character, in the year before its biggest run ever, the people who felt the discomfort and understood it were positioned for something historic, and the people who were talked into calm missed it entirely. I cannot tell you the future, but I can tell you the pattern, and the pattern is on the table in front of you right now, in plain sight, while almost everyone is looking away. The discomfort you are feeling is not the warning to leave. It might just be the signal to pay attention. Nobody sends you an invitation to the biggest moves. They only feel, at the beginning, exactly like this.